All right. Okay. Gonna crack in now. Just at the start, I'm gonna be using a presentation that was made by AirTree Ventures, which is one of the big VC firms that have been looking quite a lot into the crypto space lately. And this was put together by two of their, I think, analysts. And it's pretty much just an overview of how we got to where we are today. And it's a pretty interesting time to be looking at all of this technology, just because I really believe that it's got the potential to completely reshape the way that essentially everything functions, right? Like money is at the center of our entire economy. And if cryptography, blockchain technology, and cryptocurrencies become more mainstream and even in some cases potentially replacing fiat currency, which is, AUD, USD, as a whole, we're going to see some really significant changes in the way that essentially our economy functions. And I was just saying earlier, this is really good timing because the crypto markets have hit an all-time high over the last 2 days, with Bitcoin going past its all-time high of I think 85 grand in AUD, which is fantastic, and Ethereum's been on an absolute tear as well. So it's pretty good timing to understand more about this, but it is still very very early stage, both from a development point of view and from an adoption point of view. So from my perspective, if you're in it to make a bit of money, like it's also great to understand the technology that underlies these cryptocurrencies. So let's start out with the basics first. The reason that crypto as a concept was developed initially was to, as the slide says, respond to the flaws of the global financial and government systems. So as you can imagine, a lot of the world's GDP is actually dedicated to just moving money around, and so therefore the intermediaries, the banks, as well as the central banks who are responsible for the flow of money itself, are essential to the way that economies function and the way that the global economy functions. Now, having said that, there are still billions of people worldwide that don't have access to bank accounts, don't have access to technologies, and don't have access to intermediaries to help them transact. And so the whole concept of Bitcoin, which was the first cryptocurrency which came around back in 2009, was to actually help to alleviate some of these problems and to actually have a currency which utilized the power of the internet to transact. Right now, nowadays the concept of something like getting on a phone call and paying the ridiculous fees that you pay to make an international phone call through a landline is just a completely foreign concept. And so if you translate, because we can all just jump onto WhatsApp or Messenger and call our friends from all around the world. Now, but why does money essentially lag behind? We have the functionality essentially to transact digitally using the power of the internet, yet international bank transfers, you incur all sorts of fees as money is moved between intermediaries, and also things like currency conversion fees and all of that stuff, similar to the fees that you pay for a phone call internationally. It's all very archaic given the technology that we have access to at the moment. So Bitcoin, when it came about, was trying to tackle some of those challenges with the financial systems, and create a more functional, easy to use, and accessible digital currency. So that's one element of why crypto was initially came about. The second was the challenges to do with centralization. So started out with issues associated with governments seizing assets and property in some countries, as well as hyperinflation. So there have been a number of countries which have suffered from severe hyperinflation, where the currency is essentially being devalued to nothing. So it's essentially worthless, and that's because central banks and the intermediaries and the centralized organizations responsible for those monetary systems weren't responsible, essentially. And so they were printing money like crazy, and that led to hyperinflation, which then completely devalued the currencies, to the extent that you would have to pay for your meal up front, because by the time you finished it and went to pay a bill in a country like Venezuela or Zimbabwe, the price had already gone up. So they couldn't afford to have physical menus. Everything was just quoted as you sat down to eat. It's just completely like dysfunctional. And we're seeing similar things in the US now, right? So the federal bank in the US has said multiple times that inflation that we're seeing is just transitory. It's at something like 4.5 or 5% in the US at the moment, and if that gets out of control, and if it is worse than the central bank believes it is, then we're going to see some serious devaluation of the US dollar. And so cryptocurrencies, which are generally fixed in supply, which means no one can alter their supply in any way, don't have that. They have a very fixed inflation. And in that sense, that can't be altered later. So Bitcoin, for example, has 21 million coins as its max supply, and that supply will never change, and nobody can change it. So you've got that sense of security as an inflation hedge, given the current macroeconomic backdrop, especially in the US, as well as some of the benefits associated with reducing the cost of transacting, you know, increasing the ability of people to exchange money and avoiding intermediaries altogether. So you're cutting down on things like transaction fees and you're reducing the time it takes to execute transactions, which is all super positive for the monetary system. So a lot of people, I think, misunderstand the concept of cryptocurrency. They see it as this asset or this coin which is backed by nothing, and they say, well, the US dollar is backed by gold, and therefore it has some degree of value, and Bitcoin isn't backed by anything, so it shouldn't have any value. And I think there's probably a mistake in the way that we think about cryptocurrencies, at least at the very basic level. So the general concept of a cryptocurrency, in the same way as money, is that it can be valued based on the functions and the services and the platform it provides access to. So we ascribe value to the US dollar because it is the global reserve currency. Most goods and services around the world are transacted in the US dollar, and the US economy is essentially accessed using the US dollar. So if we apply a similar kind of logic to thinking about cryptocurrencies, you'll see pretty quickly that a lot of these cryptocurrencies have some intrinsic value based on the value that the platform itself can offer to its users. So Bitcoin is viewed more as a store of value, like gold, in the sense that nobody transacts with gold, right? And nobody's sitting with gold in their backyard as some fantastic transaction method, but it has this concept of a store of value that is usually used as a hedge against more risky securities like the stock market and the bond markets. So similarly, Bitcoin serves more of a function as a store of value rather than something that you and I would transact in on a daily basis. Whereas another platform, such as Ethereum, the value of Ether, which is the cryptocurrency associated with Ethereum, is actually tied to the value that that platform provides. Now, that platform has been purpose built to allow for decentralized applications to essentially sit on top of the Ethereum platform. And so, therefore, in the same way that all of the businesses, your Apples, your Googles, Microsofts that are based in the US, and those are the if you want to think of them as applications which give the US dollar value, Ethereum provides a similar platform whereby developers can build businesses and protocols on top of the Ethereum system, which transact in Ethereum or Ether, which is the currency, and that therefore provides Ether with value. So crypto itself refers to that digital currency that is underpinned by the value proposition of the cryptography, which is the security mechanisms, and the blockchain technology in which applications are built on top of. So that's a better way, I think, to think about what is the core value of most cryptocurrencies and what is the purpose that they're actually trying to achieve. So what is a blockchain? Very quickly, it's more or less a database which is stored online and is immutable and cannot be changed once new blocks are added to the chain. So if you view a chain as essentially a potentially infinite chain of these blocks, the way that blockchains generally work is transactions, for example. So if we take the Bitcoin blockchain, which is probably one of the most straightforward ones, each block contains a set of a certain number of transactions that have occurred. So, for example, me sending you some Bitcoin, that is a transaction that will then get encoded into a block. And when a new block is essentially minted onto the blockchain, and we'll talk about the way that that works a bit later. That new block gets added to the blockchain with all of those transactions bundled into the block. So it is a database that continues to expand with every transaction that's ever occurred on that blockchain. And so that's essentially how blockchain technology works, and that's what a blockchain is. So just going back to the olden days, essentially how we got to where we are and how systems generally work. So uh, the way things used to work is everyone, all the companies used to have their own internet servers on site, and those servers themselves would then communicate with your iPads, your iPod, your iPhone, and your desktop computer in order to access information that was located on site in hardware form um, in your company's headquarters, essentially. And so the way that the internet worked is, Apple would have their company with their servers, Microsoft would have theirs with their servers, Google, Amazon, et cetera, and your device would plug into each company's servers when it was accessing their services. So when I was going to go to Instagram to send someone a message or like some photos, I'd access the Instagram server through the internet. When I wanted to do a Google search, it'd then access the Google servers, and that's essentially how the system works. You've got a bunch of closed off, privately held, centralized data systems which interact with each other. So there are some good and bad parts about this. Obviously, Google, Facebook, Microsoft have grown to the extent that they have because there are significant network effects and scalability associated with having your own servers as well as control, which allows for faster iteration and development of that infrastructure. However, some of the downsides that we're seeing is that it leads to extremely monopolistic behavior. So Facebook, for example, have been uh, at the center of numerous scams and allegations about the fact that they are monopolizing users' data and misusing that data to exploit different stakeholders. You've also got difficulties associated with centralized control. So you'll have noticed that Facebook, for example, has become increasingly private with their data servers and their infrastructure to the extent that they're not really allowing third-party developers to access their technology and build new applications using their technology. Now, some of the bigger organizations have things called APIs, which other developers will use to access, for example, Facebook data or access Google data to use that in their own applications. But what's happening is there's increasingly centralized control of these APIs, and there's a lot less functionality that people have when they're trying to access information from Facebook, Google, Amazon, etc. And third parties all need permission to integrate with them. So there's some serious centralization in the way that these big tech companies operate. And on top of that, it's a single point of failure. When everything is centralized in Facebook's server system and something goes down, as we saw very, very recently, I think only a few weeks ago, Instagram and Facebook went down for almost 24 hours and people were sort of beside themselves because they didn't know what was going on. That is the type of redundancy that causes serious issues when you have centralized systems. So those are the trade-offs with your traditional client infrastructure. And so now we can kind of see where blockchains come in to alleviate some of these problems. So blockchains at their core are peer-to-peer networks in the sense that my devices will communicate directly with your device in order for us to send money or do a transaction or send a message to one another. We don't need anymore me to access Facebook servers and then Facebook servers to then link you in to actually receive a message that I want to send. It is inherently peer to peer. Now, the general follow on question that comes with that is, well, who is making sure that the message that I send to Elliot is secure, firstly, and also can then be tracked back, right? Because blockchains are supposed to be these amazing things where you can see everything that's ever happened, and is or theoretically infinitely scalable. So where does all of that come in? So the way that that works is you've essentially got things called validators. Now, validators are the consensus mechanism which are used to check that the messages that I'm sending, the transactions I'm making are valid. So in a basic sense, they solve cryptographic problems which use their computer power. And then once they validate that cryptographic problem, all of the transactions that have occurred in that time period get bundled into that block, and that block then gets added to the blockchain. And so as a result, as a reward for doing these computational tasks and ensuring the security of the blockchain, validators will receive rewards for their work. Now, this system at its core is called proof of work. It is by proving that you have consumed some degree of computer power, which is electricity, and the fact that electricity is a scarce resource, it is demonstrating your commitment to the blockchain and to the security of the blockchain, and so you receive rewards, such as the way that Bitcoin works with proof of work. So consensus, as I mentioned, is the process of most validators. So you just need 51% of all validators to confirm that a certain number of transactions have been done, to then add those set of transactions to the blockchain ledger. Now, the most common consensus methods, and there are a lot more that are developing now, are proof of work and proof of stake. And the whole concept of a consensus mechanism, and the way that you should understand it is showing that you are using some sort of scarce resource to illustrate that you are not a bad actor. So the biggest concern is these things called Sybil attacks, which is essentially where you have somebody that sets up a validator and pretends to impersonate, let's say there are 100 validators in the system, attempts to uh, impersonate another 50 validators. So the total system now has 51 validators, but it's actually only being run by one person. Now, if anybody was able to gain 51% control over the validator network, they have the ability to essentially undertake a Sybil attack on the network, which allows them to um, basically invalidate certain transactions or interfere with the consensus protocol or the consensus process. So the way that these work is that you contribute some sort of scarce resource, like electricity in the case of proof of work, or the token itself in proof of stake, to demonstrate that you are not a bad actor. And now, in the case of Bitcoin, given the scale of Bitcoin, it would be very difficult for somebody to set up 51% of validators, because it's just that's way too much electricity, way too much scale. Now that Bitcoin is so heavily distributed globally, it would be too difficult to do that. And so that implies with it a sense of security in the network, because you know that even if there are some bad actors, the majority of people are validating transactions and performing those computational functions in the correct way. And that's a positive for the network. Now, the downside with proof of work is obviously that requires a hell of a lot of environmental damage, because you're using a considerable amount of electricity, and most of that is generated by fossil fuels, which is, never a good thing. And so we're seeing a big transition now, and Ethereum's undertaking this transition now towards a new consensus method called proof of stake. And proof of stake, instead of that scarce resource being electricity, the scarce resource is that you put forward um, some quantity of tokens. So in the case of Ethereum, the token is Ether. You would stake or lock in a certain number of Ether tokens into the platform, and that would allow you to then perform a function as a validator in that proof of stake network. And so you get rewarded for staking those tokens, locking up those tokens with rewards in Ether. So a good way to think about proof of stake is kind of like a term deposit in a bank, which is where you receive a higher interest rate for essentially locking up a certain amount of money for a period of time. So for example, if I just had $1,000 in a savings account, I might earn 1% on that if I was lucky. But the bank might say to me, well, if you give me that $1,000, but you can't access it for 6 months, you lock it up in a term deposit, we'll give you 1.5% interest. So it's a similar kind of concept here, in that you are staking your Ether in return for rewards. And all of the validators are required to stake a certain amount of Ether in order to prove that they are not bad actors. So you have a similar kind of way to prevent Sybil attacks in a much more environmentally friendly manner, because you're not now burning as much electricity. So that's an introduction to consensus mechanisms and why they're important and how they work. And so, there are a number of advantages to these. We've touched on them briefly, but there are also some difficulties with decentralized server architecture. So first of all, it's quite challenging to scale, mainly because you essentially rely on a lot of third parties to provide their services as validators, and you need to own a considerable number of tokens in order to set up a validator yourself. And so that becomes very expensive, especially as some of these currencies continue to hit all-time highs. Also, the decentralized nature means that security bugs are very difficult to revert, because once something has been validated by a majority of the nodes, the validator nodes, they get locked into the blockchain um, forever. So there's a lot of testing that has to be done before upgrades and updates to the blockchain protocols are actually shipped, because if there's an issue, you get some serious problems. Now, if you want to look up some of the big ones that have happened recently, the biggest one is probably by a company called Compound Finance, in which there was a bug in one of their systems where they accidentally transferred certain accounts with a significant number of comp, which is their token, thousands and thousands of dollars of comp, when they tried to ship out a security or a functionality upgrade to their system. And that's very difficult to revert now, because there's no lawmakers that you can go to and say, hey, can you make these people pay me back, because it's a decentralized system, and they just had to trust that they could ask people, hey, can you transfer us the money back, and that wasn't particularly successful. So it's extremely difficult to revert security bugs. And then finally, proof of work consensus mechanisms do consume a lot of energy, but that's not a massive issue, because a lot of these blockchain protocols are now moving to or starting up with proof of stake as their consensus mechanism. Cool. So now that we've talked a bit about the basics of blockchains and cryptocurrencies and how they work, we can talk a bit about the phase that we're in with the internet and the web. And it's most commonly termed Web 3.0, and it's this big transition from centralized databases and companies like Facebook and Google towards this decentralized environment where the web is essentially open source and run by the people. So okay, so starting with the web, the web sort of started out, late 1990s, early 2000s, with all of your, simple functionality websites, Craigslist, MySpace, basic Google, eBay, and Yahoo, which are very static, very basic websites with directories, maybe basic email and chat functionality, some physical goods marketplaces with pretty pretty poor UI, and it was the first essentially foray into uh, selling products online. And a lot of people initially didn't think that had the capacity to essentially change the way that we transact. People didn't think that everyone would want to not go to stores and just open their internet browser in order to buy things. And so this was kind of the very early stages. We also saw the dot-com boom towards the end of the 90s. So once people started to see that the power of dot-com companies and the scalability and network effects of online organizations, there was massive run up in a number of dot-com stocks, which then sort of led to a bubble being the bubble bursting in the early 2000s, and kind of a reset and a rethink of the way that internet companies were going to function and develop moving forwards. And so then Web 2.0 was when we started seeing, the big companies that we know today start out and originally and begin to form in that lull phase, or that winter phase, that web winter phase in the early 2000s, with a much bigger focus on the network effect side of things. So companies like Facebook and Twitter and Amazon really building up the network effects that are possible uh, with internet technology and with online infrastructure. And we also started to see things like the development of the gig economy, things like companies like Uber and Airbnb really come to prominence, especially as we saw an increasing um, quality in mobile technologies, storage technologies as well, and generally the quality of internet that individuals like you and I at home could access, right? So even a shift from being able to access an internet connection in your home with 10 megabytes per second now to upwards of 500 megabytes to a gigabyte per second of internet connection unlocks serious value for online businesses playing in that space if you have higher quality internet. So as all the technology has continued to develop, companies like Facebook, Twitter, Uber, Airbnb have benefited substantially from this Web 2.0 era. And so now we're kind of moving towards a Web 3.0, in which you no longer need to rely on centralized and trust centralized organizations to own your online data. And so companies are now emerging, trying to build a decentralized webs with payment mechanisms that don't require intermediaries, things called smart contracts, which allow you and I to transact and interact in a way that doesn't require a third party to intermediate. Decentralized finance with all sorts of new functionality and allowing money to move between people in new and faster and cheaper ways. Things like NFTs and NFT standards. So NFTs stand for non-fungible tokens. Uh, the metaverse, which is kind of an online worlds, and they already exist, in which people pay thousands of dollars for land in online worlds. A good one to look at if you want to have a look at that is called the Sandbox. That's one of the biggest ones. And then we're also seeing things like decentralized autonomous organizations, in which people are banding together to form companies or organizations which run in a fully decentralized way. So people will own governance tokens in the same way that I would own shares in a stock or shares in a company. And they use those shares or those governance tokens to vote on the direction of the DAO, the decentralized autonomous organization. So there's some amazing innovation in the Web 3.0 space. It's really started out in 2018, probably a bit earlier than that actually, and it's really kind of coming to fruition now. But we are still very early stage. And I think just to round out this kind of story of the web, um, what's interesting is a lot of the big development and a lot of the new waves of technology are coming. They come right when everything crashes. So Web 2.0 was born out of the big dot-com boom, and then bust in the early 2000s. Web 3.0 and the prominence and the build-up now of the decentralized world, and Web 3.0 actually came after Bitcoin, hit uh, whatever it was, like $20,000 in 2017, and then crashed back down to 6,000. And then this crypto winter ensued. A lot of the biggest innovation comes actually at the time when nobody's really paying attention and nobody's really invested in the space because the money's not there. But then when the money gets there, as it is now, a lot of people might think it's actually too late to now get in. So if you can recognize trends and capitalize on things when nobody's paying attention, that's often the best way to learn and to get involved and to build something. So yeah, so there are a couple of waves of crypto that have played out, and the general cycle, and it's something I just touched on then, is that there's a certain level of interest in cryptocurrency, which then leads to activity, more people looking into it, more people engaging in the different protocols that exist, and then that leads to the price rising, which leads to more interest, activity, and it's this kind of flywheel effect. And we're seeing exactly the same thing now. And then if the price, crashes down a bit, the interest will decline, the activity will decline. And so that's sort of the process that it's undertaken in each of these waves. Now, the first wave was around the time when Bitcoin first began. This was extremely, extremely early stage. You can see, in mid 2011, it peaked at $30 per Bitcoin, which is ridiculous to think about now, given that it's at $85,000 per Bitcoin. But that was when people started to get involved, started to mine Bitcoin and set up these um, essentially, yeah, mining systems for Bitcoin. We also started to see the formation of centralized exchanges, so Coinbase, which is one of the biggest now, if not the biggest, Mt. Gox, which no longer exists, and Kraken. And there was an initial focus on trying to build wallet technology. So wallets is kind of the same way you have a physical wallet, you have an online wallet for a lot of your cryptocurrency. We might talk about that a bit later. Then the second wave was from 2012 to 2016, in which there was a bit of a lull, but Ethereum essentially came into the fray in, I think, 2012, which introduced this idea of a smart contract. Now, this is quite revolutionary for the crypto community and the blockchain technology from a functionality perspective. Right now, Bitcoin we talked about is a store of value, and you can transact on it if you want to, but at its core, and that is essentially what it is. It doesn't have much functionality beyond that. Now, Ethereum was built with the function with the vision in mind to have these things called smart contracts, which allow people to set automatic agreements, programmatic agreements to exchange goods and services for money that automatically execute without an intermediary or a third party, so long as certain criteria are triggered. And so this is, a game changer because it allows you and I to have a legally binding or, unchanging agreement between each other that doesn't require an intermediary like the courts to enforce that I will undertake my side of the obligation. It's a completely programmed contract which ensures that if a given condition is met, that you will be paid or I will transfer you a certain number of goods or services. And so this kind of all of the development around this started from 2012 to 2016, and there was a big pickup in prices towards the end of 2016, and then right about 2017, you can see the peak here is when everything kind of crashed down, and you can see the developer activity started to fall, startup activity in the space started to fall, and the social media interest in blockchain and crypto fell substantially, and this was known as the crypto winter phase from 2017 to 2019. But having said that, there was a considerable amount of development happening at this time with new protocols popping up, NFTs becoming a much bigger part of the ecosystem. There was this big mania around initial coin offerings, which were had some good media, had a lot of bad media for all the scams that were undertaken uh, and this concept of interoperability, where people realized that individual blockchains were great, but you know, in an ideal world, you need to be able to interact on Facebook and Instagram and Google and Amazon all at the same time. So we needed functionality which allowed blockchains to interoperate between each other. And then finally, we had the birth of stablecoins. Now, stablecoins are a type of cryptocurrency which are pegged to, in most cases, the US dollar, but essentially to any fiat currency like AUD or USD. And so these first started in around 2017. And so yeah, you can see it again, the flywheel effect that we were talking about here, where the interest picks up, activity picks up, and the price goes up, and then when all of that starts to tumble down, you see all of it tumble down um, together. So we've seen a massive increase in the price of cryptocurrencies, which has also led to more social media developer and startup activity, especially in recent years as we've kind of come out of this crypto winter and are now in this raging bull market in cryptocurrencies, which is just continuing to ride up and up and up at the moment. And so now we're in sort of a wave four where things are continuing to hit all-time highs. This is now even a bit dated. This was September, and Bitcoin's kind of come all the way up here now, and Ethereum's well past, or if not around, its all-time highs now. So it's an era where there's a lot of focus on DeFi, which is decentralized finance, which is unlocking all sorts of yield and value for people in ways that have just never been possible before, right? Like most of our bank accounts won't earn us more than 1% in a savings account at the moment, but some of these DeFi platforms are able to give people a yield on cryptocurrencies of upwards of 5 to 10%, and for some of the more risky ones, 50 to 100%, at an annualized rate, which is just absolutely ridiculous. And then we're also seeing things like stable coins, which are looking to replace fiat currency altogether by having cryptocurrencies that are pegged to the US dollar, for example. And then we're also seeing a big rise in the amount of trading and hype around NFTs and gaming. So NFTs, as I mentioned, are non-fungible tokens, which are most commonly associated at the moment with art. So, for example, these are CryptoPunks, and some of CryptoPunks, which is just artwork that looks like this, are selling for upwards of $100,000, $200,000, if not more even. So we've seen this massive run up in the amount of NFT projects that are transacting at the moment, which is just a lot of hype, and I think people have a lot of money in their pockets, especially following all the government stimulus at the moment. So there's a lot of money being pumped into NFT projects and communities and hype being built around this aspect of blockchain technology. Cool. So that's pretty much the intro to cryptocurrencies and blockchain. There's so many things we can get into. We could get into NFT projects. We could get into, stable coins and their role. Um, but yeah, it seems like there's just this endless rabbit holes you can find yourself falling into. Uh, but we'll just take a quick look at regulation now. So I think most people's concern with cryptocurrency is that it facilitates terrorism and all the worst things, human trafficking, because money is no longer trackable. And I think that's one of the biggest concerns that people have. They say, oh, no one can track Bitcoin. Nobody knows, who's sending money where. And I don't think most of that is really warranted if you look at the way that the technology works and the way that the KYC, which is called Know Your Client or Know Your Customer, regulation works. That's not really a valid criticism because at the end of the day, if I'm going to try to money launder, let's say, and I want to, buy a bunch of Bitcoin, I have to send that from a bank account, which is KYC'd, onto an exchange and then transact. And then if I ever want to cash out on that, I have to cash that money back into my bank account, which is KYC'd. So the money can kind of be followed from that sense in that they know that it's me that's doing the transacting. And if I put $100 in and then all of a sudden I'm taking out, $100,000 from Binance, for example, or any of the other crypto exchanges, that's extremely sus, and it's pretty obvious who is doing that, because at the end of the day, in order to get my bank account in Australia, they go through all of my personal identity verification checks. So the way KYC works, that's not really too prevalent of a of an issue. And then also on top of that, what's great about blockchains is that every transaction is locked into the blockchain. So if I was really going to money launder, you could actually see exactly which address the money is moving to from the second I move it onto an exchange to the second somebody takes it out from anywhere in the world. And you can see those wallet addresses. You can see exactly what's happening, which in some ways provides more security than we've ever had before, um, when it comes to preventing terrorist financing and human trafficking and all of the illicit drug trade, et cetera, et cetera, et cetera. So I think it's extremely powerful, and the way that regulation comes into effect will hopefully be positive in order to continue to stamp out all of the bad uses that people have for money. And I think having everything on digitized blockchains is actually going to be more a move in the right direction. And the way that things currently work with cash and um, poor digital records in developing countries means that a lot of those issues are rife in those areas. And if you had everything on an immutable digitized blockchain, a lot of those issues would no longer be issues. So regulation is still a concern, and our hope is, I guess, that countries won't stamp out blockchain completely, but it is happening. India have considered restricting or banning cryptocurrencies altogether, and China have actually banned cryptocurrency usage to transact altogether as well. Um, but I think people are also realizing that you want to be part of the latest developments, right? If 10 years ago the US said, "Oh, we don't like the concept of Facebook, we don't like the concept of Amazon because it looks like a monopoly, it looks like this technology is a bit dangerous," then they wouldn't have some of the most booming economies with some of the most successful companies in the world today. So I think most of the Western world is actually moving towards favorable crypto regulation. They're not trying to ban things completely. They're trying to be forward thinking, and they're trying to engage with these communities to find the best ways to regulate and move forward. So I think that is a positive generally. And I think as people begin to realize that, uh, the SEC, for example, in the US, and the government in Australia aren't trying um, to be pessimists and stamp out the use of crypto altogether, the more favorable it'll be for people who are looking to get into the space, whether that's investing or starting new blockchain based protocols, new cryptocurrencies in the area. So it is looking positive in general, but there are some concerns. So I raised the issues with KYC requirements. There's also a big debate at the moment in the US about whether or not cryptocurrencies are viewed as a security. So in the US, securities are regulated obviously by securities laws and securities regulations, which are quite strict. In the US, there's something called the Howey test, which is used to determine whether or not something qualifies as a security or an investment contract. But the general concept of what a security is you exchanging money in return for some financial benefit. So um, happy to talk to you a little screw up of mine and a great lesson for me. I invested recently in a cryptocurrency project, or not a cryptocurrency project, but an NFT project, which was based on a marketplace. So let's say, and they're called the Piggy Soul Gang, which is essentially sounds stupid, but it's it was the 10,000 of these NFT images which were linked to a marketplace, an NFT marketplace known as Alpha Art. So imagine Gumtree or Facebook Marketplace issuing an NFT, and the holders of those NFTs were entitled to receive 30% of the 2% transaction fee that the marketplace charges on every single transaction that goes through the marketplace. So if you think about the volume of Facebook Marketplace, for example, or Amazon or some of these NFT marketplaces, it is substantial. And so owning one of these NFTs would entitle you to that cash flow, which in the long term could be significant if the NFT marketplace really blows up. So it sounded like a great idea. Spent a decent amount of money buying this picture of a pig, and then a few weeks later, they announce in their community that their U.S. legal advice has been that it is a security because they are promising a financial return in the form of their marketplace fees to people in exchange for the money that you pay for a pig, like a picture of a pig, right? So that was viewed as a security, and they had to scrap the royalty system altogether. And so as a result of that, essentially the prices of these NFTs just tanked because there was no longer that cash flow associated with the project, and it was goodbye to that investment for me. So that's a big debate at the moment. If you're ever looking at any kind of investment in the crypto space, I would be conscious of whether or not even the most basic definition of a security is being satisfied, and if so, maybe just do your due diligence to make sure that they're either addressing that or have some sort of plan of action. And then we've talked about KYC, and then finally, centralization is it's kind of like it's one of those things where countries don't want capital flight from their systems, right? Like these blockchain is so revolutionary, and the reason why I'm so bullish on the concept is that it has the potential to completely revolutionize the way that the financial system works. We will no longer need the RBA to regulate the Australian dollar. We'll no longer need the Federal Reserve and the Treasury in the US to regulate the US dollar. We will have currencies that can function completely independently in a decentralized way, completely devoid of third party interference. And that will lead to significant capital flight, right? Why would I hold a USD or the Australian dollar and rely on the RBA to do right by me if I can go to a decentralized system that I know for sure will? And so a lot of countries are worried that there's going to be significant capital flight, which means people taking money out of those economies. If cryptocurrency becomes, more mainstream and this decentralized, um, like equality-based system comes into effect, and so countries like China have already done it, and those with more totalitarian regimes are trying to stamp it out so that they don't lose control. And the US has had a similar response. I think they're slowly realizing that this is a serious threat to the way the central bank works and the US government's control over the economy. And so that is a major risk if they decide to come in and regulate by banning some of these entirely. So there are a lot of tension points. There are a lot of threats to the way that the regulation is panning out. But on the whole, it seems like a lot of countries are getting on board and trying to support crypto assets generally. Yeah, so I mentioned that China have kind of cracked down by banning crypto mining, and now cryptocurrency completely, which is concerning. But then we're also seeing other developments. So El Salvador, which is one of the countries that was hit quite hard with hyperinflation, have actually now adopted Bitcoin as their legal currency, which is an extremely interesting development in the space. And they're utilizing something called the Bitcoin Lightning Network to enable transactions in the form of Bitcoin. So I could go down and get a coffee and pay in Bitcoin on my phone. So it's got a fantastic capability of being free from government interference and free from the hyperinflation fears that a lot of these developing countries have faced. And so countries are now even um, you know essentially boot camping um, you know, like cryptocurrency use for general day-to-day transactions. In developed countries, this has come more in the form of something called CBDCs, which is central bank decentralized currencies. Yeah, I think that's it. Central bank decentralized currencies. Just to make sure I'm getting that right. Yeah, central bank digital currencies is CBDC, in which countries like Australia and the US are actually trying to create their own digital currencies that are either freestanding or backed by the fiat currency. So, for example, a digital US dollar coin that was backed by a single US dollar fiat currency. And so that's kind of where things are moving from the regulatory point of view and government issued cryptocurrencies. But I think at its core, people are kind of annoyed by the concept of centralization and having governments interfering with the way that money functions. So I don't know the extent to which these CBDCs will be successful in curbing the massive inflows that are coming into your traditional decentralized cryptocurrencies like Ethereum, Bitcoin, Cardano, Solana, etc. Now, a lot of a lot of blockchain protocols realize the threat that regulation poses to the future of cryptocurrency, and they want to make sure that governments are on side rather than viewing cryptocurrencies as a bad thing. So, 11 institutions have come together to form something called the Crypto Rating Council, which works to essentially score new crypto projects on a set of 36 questions in order to determine the risk profile and the nature of these cryptocurrencies. So we're seeing a lot of active participation and engagement between government agencies and cryptocurrency protocols in order to make sure that the regulation environment moving forward is positive and allows for innovation and development in the space, which is extremely positive. Australia is a little behind the curve, but I'm aware that like a lot of work is being done to research the space, and there are a few blockchain protocols that are based out of Australia that are working quite closely with the government to find ways to ensure that regulation is pro blockchain, but still alleviating all of those concerns with anti money laundering and know your customer related issues. Okay. So that's essentially the introduction. As I said, there are loads more things we could talk about. But just to kind of end off, there are a number of different resources that you can use to do your own research and learn more about different cryptocurrency protocols. The best resource, or one of the best resources I would recommend is CoinMarketCap, which is this one here, coinmarketcap.com, which essentially shows you the highest market capitalization cryptocurrencies, a bit more information about them, plus the links to all of their different communities, whether that's on Discord, on Twitter, on Facebook. Um, and it also gives you access in most cases to the white paper, which is the original sort of founding document of that cryptocurrency and what they're trying to achieve long term. So that'll give you a great introduction to what the cryptocurrency is trying to achieve, and then you can gauge how successful it's been in doing that. There are also loads of great podcasts and YouTube series in which to learn more about cryptocurrencies from a YouTuber perspective. Hashioshi is a really good one. There's also, and then I think one of the biggest ones is called the Coin Bureau, which is this British guy named Guy, who does a lot of educational type content on different blockchain protocols and mechanisms. A16Z, which is the venture arm of the Andreessen Horowitz, um, I think the private equity or venture capital fund based out of the US, have this thing called Crypto Canon, in which they've got a series of videos running through what blockchains are in a bit more depth than what I've done today with a bit more time to explain how it all works. That's really great as well. And then there are some great podcasts. Bankless is one. Up Only. All of like Hashioshi and the Coin Bureau stuff is also in podcast form. So I'd recommend listening to that as well. Yeah, so that's been an introduction to cryptocurrencies, blockchains, the Web 3.0 challenges with regulations, and some of the consensus mechanisms, and a basic insight into how cryptocurrencies and blockchains work. Obviously, this has significant potential to completely reshape the way that our financial system functions, and it's extremely exciting. And the earlier that you can learn about it and get involved in the space, the better. Um, Depending on interest and engagement, I might do a session of how you can start to set up your own cryptocurrency wallets and how to use the exchanges to buy cryptocurrency and store it securely, because that's another big issue, security. Uh, but until then, yep, that sort of wraps up this intro. So thanks guys for listening.